Money FM 89.3, best of prime time. Market View on Money FM 89.3.
Welcome back to Money FM 89.3, and we are going to look at how Chinese markets performed as we near the end of November, and probably a better month actually for mainland Chinese stocks. Now, the road has not been smooth, but we've seen signs of situation stabilizing, at least for mainland Chinese equities. The same can't be said, though, for the Hang Seng, which has taken a step back on renewed uncertainties, perhaps hitting their property and the tech shares listed out in Hong Kong. Well, to make more sense of what's going on in greater Chinese markets and the divergence between mainland China and Hong Kong today, we're joined once again by Mr. Peter Chun, the founder of Silverbear Capital in Hong Kong, to help us take stock of the month that was for greater Chinese markets and what to look out for in the month ahead and also the upcoming new year. Peter, thank you so much for joining us once again. Glad to hear you and your loved ones are still safe and in good health during these times. And welcome back to the show, sir. It's been a while, and I hope you're all right.
Thank you.
All right. So, Peter, let's start off with mainland Chinese stocks. Now, we are seeing that they are taking a bit of a step back in today's session, and really it hasn't been the smoothest ride still. However, Shanghai and Shenzhen have been steadily climbing and posting better days than most over this month. Is this a sign, though, that the worst may be over, especially with regards to the uncertainties hitting Chinese markets over the last 3 to 4 months?
Well, I think the China stock has been convoluted by a lot of the recent speculations about all these property developers defaulting on the bond, and obviously the total bond amount exceed the total economy of Japan, which is a lot of money. So I think the speculation is due to one of these very correlated ingredient that a China citizen would be concerned about, because a lot of the China citizen has this owning a property mindset to their lives. And for the last 10-20 years, these developers have been doing very well, and they have been assisting the economy to grow. But at the same time now, this ripple effect had started to happen. I'm sure this would compromise the momentum a little bit. But now, since the stock has been adjusted for the last 2 months or so, I think a lot of the bargain hunters has come by again to see if they can seek some stronger component in the market that's worth betting on.
All right. And what part are valuations playing here, Peter, especially with stocks declining in those recent months? You did talk about bargain hunters perhaps taking a closer look at Chinese stocks. Is this the right time to perhaps pick up steals and discounts out in the markets at the moment?
It is. Actually, valuation still speaks, which is a good thing. And I believe some of the developers, when they're trying to walk out from this bond default, they've actually offered some of the developments in real solid asset back to these bondholder, rather than promising them that they will get the money back in return to avoid default. Meaning these bondholders still recognize the valuation being played here on, say, a particular piece of property, or maybe the real asset value that the developer had contained within the balance sheets. So I think same rules and engagement with valuation still exists. So this is a good sign for the whole market space to keep its pace with what's going on and ongoing forward.
So I'm glad you brought up the property developers here, Peter, because as we know, over the last couple of months, the ever-present concern really was regarding property developers like Evergrande and Kaisa. It seems that markets have pretty much gotten used to the uncertainty. Have they priced in any potential downside from the real estate sector, which really hasn't been fully resolved yet? But do you think that markets might have already priced this in already, hence hinting at perhaps this bottoming out in some shape or form?
Yeah, I think the market has priced it already. I mean, the adjustments were significant, and the economy is growing, especially with its infrastructures. Although COVID kind of stalled the whole momentum quite a bit, it doesn't really stop, from the population growing. And when you have the economy being built and constructed better every day, then you can then sensibly to see that the property prices will not depreciate as such. So I would probably say the pricing has been already being adjusted, and it's already being priced currently by the investors, so that the correct outlook has of a particular developer is being seen already on the market space now.
All right, we're still meeting to Peter Chun, the founder of Silverbear Capital here on Money FM 89.3. He's out in Hong Kong, giving us a better outlook of how greater Chinese stocks performed. And while we saw mainland Chinese stocks find some sort of stability, Peter, Hong Kong shares still had a bit of a bruising November. We saw the Hang Seng down about 5% at the start of the month. Any reason why Hong Kong is looking a bit more vulnerable than, say, its counterparts on the mainland?
I think mainly that the Hong Kong market is also led by a lot of the high-end technology guys listed in Hong Kong, for example, Tencent. And obviously these guys are in the index, and it kind of drives as the engine for the train for Hong Kong as well in the market space. So what we're seeing right now is overall is steadying already, but again is hovering around a 7-week low. And as I said, the concern linger about a regulatory crackdown in China that has crypto industry ranging from technology and ride-hailing to private educations. We believe the Hang Seng Tech Index will regain its balance very quickly because it did rose 0.7%, while Shanghai Composite Index dropped 0.1%. So from figure-wise, it's vulnerable to a speculation, but currently it's doing okay compared to Shanghai right now. Stocks were the biggest loss this year and led the pack of gainer on the benchmark, as say some of the people like Alibaba Group Holding rose at least 2.1%. The stock has lost more than 40% so far, I think, in 2021. And some other guys, which is doing okay on their balance sheet, but was convoluted again or compromised by the property situation in China's New World Development, was the worst performer because with a decline of 5.8%. So the suspended trading, Tencent Holding didn't really help. As everybody knows, this is the operator of WeChat with its 1.2 billion users. China decided to delay or suspend the launching new apps and updating existing apps as part of the temporary administration guidance. And this obviously would have, again, compromised Tencent's momentum. And this would, of course, lead the Hong Kong market to slow down.
Let's stay in the Hang Seng Tech sector, Peter, and I want to get your take on China's e-commerce giants, because it seems based on those recent results and current market trends, based on what analysts have been saying, there seems to be a shifting of favor from Alibaba to JD.com. Now, is this significant? And if so, why do you think number 2, that's JD.com, is getting more favorable looks now than number 1, Alibaba? And could we actually see a changing of the guard because of recent momentum?
That's a very good question. I would probably say this is a contribution from the COVID situation to JD, And JD has made this comeback quite a bit from being public in the US and now being public also in the Asia Pacific, making them a little bit more local now. And as everybody knows, JD has been focusing on a lot of the logisticalized stuff. They actually spin off the logistics division as well, having more money now to kind of perfect their ecosystems. And during COVID, obviously, a lot of people will see that it's hurting the retail, but it's actually sweetening the e-commerce guys. Now, with a population like this in China, and JD is right next door to getting a trophy here, I think it's natural for the market to say, hey, let's kind of invest into JD a little bit while there is certain issues that might come again around Alibaba.
All right, Peter Chun, a founder of Silverbear Capital, thank you so much for joining us today on Money FM 89.3. Peter, as always, I wish you and your loved ones continued health and safety during these times. We look forward to next time you can join us in the show. Meanwhile, stay safe, sir, and I hope you're having a good Thursday afternoon out in Hong Kong.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at moneyfm893.sg or download our audio app. That's AWEDIO. Available on Google Play or the App Store.